How Governments Create Money, QE and Debt Explained. Hey everyone, welcome back to the channel. Today we're diving into a topic that sounds complex but affects every dollar in your wallet, how governments actually create money. We'll break down quantitative easing, national debt, and how it all ties into the money supply. So grab a coffee and let's demystify some economics. Let's start with the basics. Most people think governments just print money when they need it. While that's partially true, it's a bit more nuanced. In reality, in most developed countries like the US, central banks, not politicians, control the money supply. In the US, that's the Federal Reserve, often called the Federal. They don't actually print most money physically, they create it digitally through something called quantitative easing, or QE. So what is quantitative easing QE? Think of it as the central bank injecting money into the economy, but instead of handing out cash, they buy financial assets, mostly government bonds. Here's how it works. 1. The Fed creates money digitally. 2. It uses that money to buy government bonds from banks. 3. Those banks now have more money on hand, so they can lend more. For in theory, that boosts economic activity. And just like that, money is created without printing a single dollar bill. Sounds magical, right? But it's also risky. Okay, so where does government debt fit into this? When governments spend more than they earn in taxes, they borrow the difference, usually by issuing treasury bonds. These bonds are basically IOUs. Investors buy them, banks, pension funds, even foreign countries. And yes, sometimes the central bank buys them too, that's QE. So the government gets cash to spend on programs, infrastructure, social services, you name it, and promises to pay it back with interest later. That's how national debt grows. You might be wondering, isn't QE just money printing in disguise? Good question. Technically, yes. But there's a key difference. With QE, the Fed isn't handing money directly to people, it's swapping assets. It's adding liquidity to the system, hoping that banks lend more and consumers spend more. But here's the catch. If that money just stays parked in bank reserves and doesn't flow into the real economy, it can lead to asset inflation, rising stock prices, housing bubbles, without boosting wages or production. QE and government borrowing aren't free lunches. Here are some risks. Too much QE can lead to inflation, too much money chasing too few goods. It can inflate asset prices, making housing unaffordable. It can devalue a currency over time. And large government debt might limit future spending or force higher taxes. But, and this is important, it's not all bad. During crises like the 2008 financial crash or COVID-19, QE helped prevent a total economic collapse. So, should we be worried? That depends. Moderate debt and targeted QE can be powerful tools. But long-term overuse? That's where economists start sounding the alarm. The key is balance. Stimulus in bad times, restraint in good times. Unfortunately, politics often pushes governments toward more borrowing, not less. So to wrap it all up, governments don't just print money, they mostly create it digitally through QE. They borrow money by issuing bonds. And while this system can keep the economy afloat, too much of it can lead to big problems down the road. If you found this helpful, give it a thumbs up, subscribe for more bite-sized finance content, and let me know in the comments. Do you think governments should keep using QE, or is it time to rein it in?